अभी कौन आया? अभी तो ये भावे जी के ऑफिस वाले होंगे, और तो कोई नहीं लग रहा मेरे ख्याल में।
Durga Prasad sir, namaste and welcome. This is Rammohan Bhave.
How are you, Bhave sir? Let me video.
Good sir, good sir. After a long time.
Yes.
But I think this online has made it possible. How is your health, sir?
I'm good.
Okay, that's nice.
I mean, 2 years at home and all 2 years movement curtailed. I finished it in the last 1 month.
Oh, that's nice. Where all you moved out?
No, I didn't move out anywhere, but this month all board meetings, everything was physical.
Oh my God. Oh my God.
I'm on a couple of companies as independent director.
Okay. Couple is couple of.
I mean, I'm about 4 companies I'm there.
Okay. That's great. But they started a physical meeting.
No, actually, all these days we had virtual. But since it is more than a year and a half, my board said, why not we meet?
But is it allowed now?
Yeah, it is allowed. No, why not?
Okay.
No, September.
But I thought it was extended.
No, it is extended. It is up to you. You can have a meeting. No problem.
Okay. So now it is optional.
Optional.
Originally it was mandatory.
Yeah, mandatory.
Mandatory online.
AGM virtual.
Virtual was mandatory, no?
Virtual was mandatory.
Till September.
For AGM mandatory. I think
for AGM. Okay. But board meeting virtual was mandatory till September?
Yes. No,
Okay.
they gave option. They have extended it up to December, but then for quarterly meetings, they have made it optional to the board. There was no restriction that you should not meet. But nobody wanted to meet, as simple as that. People were coming from Bombay and all. Who was interested in meeting people from Bombay?
Right. I like that.
Hi, Sandeep.
Yes.
I was in Delhi. You're on mute.
You had said you told me that you will tell me in advance when you will be coming.
No. What happened was I came on Monday, but flight was late, slightly late, and then I checked into room, and then all my colleagues were surrounded with me. And then next morning we had this board meeting. Chairperson flight was diverted, so it was delayed by about an hour. But then I had to rush the agenda and came back to the airport. So it was just a day trip, 1 night there. But actually, it's a QRB meeting.
Okay. There is always next time.
Yeah. Usually I used to travel same day, but now I am not taking chances.
Yes.
It's difficult to travel same day. So much of
distance.
Getting up early.
Yes.
So usually, what is the attendance, Sandeep?
Pardon?
What is the attendance for these programs?
Attendance, there are around 100 persons will be attending.
I think 50, 60, 200.
Few people joined on YouTube and few joined on this link also.
There is a YouTube link also, no, sir? So some people join there.
I've gone through the newsletters. They are very informative. I mean, good articles are there. Couple of them I really like it. I told Sandeep one article.
Yes. I conveyed it to Bhaveji. Today also we got our new newsletter issue that I will send to you.
So Durga Prasad sir, we are happy that you found our newsletter valuable and good.
Normally, I read something that comes to me. I have this habit of reading books. I read articles. I mean, I'm subscriber to almost 30-40 book magazines, including HPR, your Wharton School, all this. So if it is coming from a professional group, I'll definitely read.
Sandeep ji, if Durga Prasad sir has sent compliments on WhatsApp, then incorporate them in the next newsletter.
Okay.
So that our newsletter's brand will improve.
Today also we will send him the edition. The same author has written an article in this newsletter also. So let Durga Prasad ji have a view on it, and then combined views we will publish in next newsletter.
Abhijit, I have a suggestion. You cover about the valuation of these new companies. You know?
Valuation of what?
New breed companies, all the startups. The model is slightly different. No, it is on the ARR, annual run rate.
Startup valuation, we already had 2-3 webinars.
On the newsletter, because
newsletter.
Different model. So it will help people. So just join.
Yeah. In fact, we also had a startup celebration week in July for 7 days.
Oh.
So
in
there were
this
40
newsletter
speakers. Yeah, Sandeep bolo.
In this edition, one article is also on startup valuation. You just have a look on this and sir, then tell if it is okay or then anything else. Yes. Bhaveji posted. Bhaveji sir, can you post or I should post too?
And it is written by our Kolkata friend only.
Yes.
So Durga Prasad ji, how is Kolkata?
Kolkata, I've not been for 3 years now.
Oh.
I'm from Hyderabad. Na?
Right.
I've not been there.
I thought the institute matters maybe still keeping you busy.
No. I'm out of all that.
Okay.
Once you have achieved the post, that's it. I don't think we should go and peddle with it. This council also offered me something, but I did not want to join any committee. Earlier council, I was there for the global summit and all that. I only brought the TOLA speaker and from TCS, all those people. But otherwise, not active with any.
Hello, sir. It is 6:30 and our speaker Ankit ji has also joined. So you start with your inaugural speech.
Sure. Thank you everybody for joining this webinar, and it is our proud privilege that Durga Prasad sir is here. He is the past president of ICAI, and my memories with him go a long way, because in the many conferences, national and regional conferences, I had the privilege of hearing him, and today he is our chief guest. And our close friend Ankit is a speaker today. And everybody knows Ankit. So what we have decided is whenever there is something new coming up, we should harass Ankit sir, because he is the most up-to-date man on anything new coming in. So when it came to the standards of 2022, we said Ankit will have to go back. When the valuation of inventory, we realized that it is the first time in the new standards. Then we thought of Ankit. So Ankit has become our man who keeps us up to date always. Yes. So Ankit ji,
AVP का अंकित बना लिया
coming here, and I, in the capacity of president of Association of Valuation Professional, is very proud to inform all of you that our association is progressing a lot. And already you are all seeing that the webinars are happening weekly, that too on different subjects, and that too contemporary subjects. One latest news is that like we had a Zomato IPO valuation panel discussion, we have planned on 12th November Oyo's IPO panel discussion. So I'm sure the separate invitation will go to trouble my go-to man as usual. And the life membership of our association is 5,000 rupees. And I'm sure those who have, would like to attend, join this association, they are welcome. Our association has an extreme ease of taking membership, as I say. And you can just Google Pay to my number and you become a member. So in a very short time, you can become a member, and we have got a big number of members. And I'm writing in the chat box the number on which you can Google Pay, or the UPI ID if you are not on the Google Pay. So for Paytm or anything else, Mohan Bhavetu at OK HDFC Bank, that is for the UPI IDs. You can become a member. A few things which are matter of pride for us recently are, we have succeeded in entering in a tie-up with SME Chamber of India, and Dr. Salunke, Chandrakant Salunke, who has the Association of SMEs, around 15 lakh members. We have become their knowledge partners. And I'm sure the AVP has so much of the knowledge people, and also the reputed speakers who also accept our requests, that we are looking forward to become knowledge partners, many, many more. Our discussion with Canada and USA valuation bodies is going on. Our webinars are there weekly. Our new newsletter has already come in, 2nd October valuation day. Having said that, we have members from 34 cities now and 11 states. So a national society in the formation stage is going to make a big difference. Our suggestions to the IBBI on the changes suggested in the international valuation standard are already in process. A startup week which was celebrated in July had got a huge demand, and every time people are requesting us to have a lectures on startup. In fact, for me also, just half an hour back, I finished one lecture on startup valuation from 3 to 5:30. Having said that, our dreams are big, and our main goal is to educate the valuers, whether they have passed or not. Anybody can be a valuer, whether he is a valuer or not. So far as he is interested in valuation profession, he is welcome to join our association. So even those who are yet to pass RV, we are holding them sessions, and those who have passed RV already, we hold a knowledge session, as well as we mentor them, because there are quite a few who have already done more than 100 valuations like me. I am sure there are more than 10 people at least who have done 100 valuations at least. So that gives us a great strength in terms of the teamwork has been so fantastic that there is always somebody to catch on if the football is falling somewhere. Having said that, we also have the members from foreign countries. We have a member from Canada. Yes, we have a member from Canada now, London, Melbourne, Australia, and Dubai. So all these international members are making our team further strong, and they are already interacting with the respective countries' valuers organizations to become the tie-up partners. Having said that, I am proud to announce that we recently had a Zoom meeting with IIBV, and IIBV is a Canada's Valuers Association. So they have shown a lot of interest in having the knowledge partnership. Valuation is an endless game. It is a game of creativity, but there are huge prospects getting created arising out of many areas. One is the startup valuation, another is the ESOP valuation, third is the intangibles valuation. And we are hoping that very soon the Valuation Act will get passed, which has been postponed for almost a year, unfortunately due to COVID. But once the Valuation Act comes into the play, then the whole atmosphere is going to get further charged up. The respectable audience who have joined here with a lot of expectation, I am sure they are going to get a big treat today, knowledge treat today. And with the blessing of ICAI past president Durga Prasad ji, who is from Hyderabad, we are able to have this online always. All our programs are online, our newsletter is online, our meetings are online. So do become our members and take the advantage of this. It's a lifetime membership fee of 5,000 to be sent by Google Pay or UPI ID. And there is no annual fee. I repeat, there is no annual fee. And whether you are a registered valuer or not, if you are interested in valuation profession, you are welcome, whether it is land and building, plant and machinery, or securities or financial assets, whether you are an engineer or you are a MBA or you are a CA, cost accountant, company secretary, and even some of the IIMs are our members. Some of our members are prolific writers. Some of our members are past presidents of the institutes. Some of our members are actually our senior most member is of the age of 70, and he has passed the exam with 77 marks. So that makes a very good pitch for us because he has inspired a lot of members here. There are people like Sandeep Agarwal, who is always in the front end as far as the webinar is concerned, and thanks to his hitting sixers after sixers, every week we see one webinar, that too with a novel subject and fantastic speaker, and then very high profiled chief guest also. So with this, I hand over to the coordinator and thank everybody for joining here, and also appeal everybody to become our member. Thank you.
Thank you, sir. Now, our member CA Veena Pateji will give formal introduction of our chief guest of the day. Veena ji, yes. Veena ji, unmute yourself and just.
Hi, good evening all. So the topic for today's webinar is IBS 230 practical aspects of valuing inventory. Since inventory is a major component of cost in any manufacturing or trading industry, and we have with us today a veteran in cost accounting field. That's our great honor, who had been a past president of Institute of Cost Accountants of India. It's my pleasure to introduce our chief guest, CMA AS, Dr. AS Durga Prasad. So he's not only past president of Institute of Cost Accountants of India, but he had also been former member of Company Law Committee, Ministry of Corporate Affairs. He led a task force on costing in Healthcare, Ministry of Health and Family Welfare, Government of India, and also he was member of the committee. So he was also independent director on NCC Urban Infrastructure, NCCIH. He was director in Swell Financial Services. He had chaired the Department and Industry Coordination Committee of Osmania University for a continuous period of 3 years. He has 35 years of, he had been associated for 35 years with various academic institutions such as universities, autonomous colleges in different capacities, and he was instrumental in introducing new syllabus in line with market demand. He has over 37 years of experience in financial management and cost management in variety of industries. He has practiced as management consultant. His experience includes financial advisory services, strategies and business development for SMEs and different sectors, including pharmaceuticals, infrastructure, IT, discrete manufacturing, etc. And providing cost management systems and MIS system for large number of units. He had been involved in all facets of corporate strategic management, including developing business models, financial restructuring, mergers and acquisitions, valuation of companies, capital structuring, and advising clients on future plans related to fundraising. He was also involved with number of public offers and was advisor on number of companies. He had been involved in business valuations and techno-commercial appraisal for many companies. So I once again welcome Sir Durga Prasad to this August gathering. Thank you.
So now our chief guest Durga Prasad ji will speak words of wisdom from his side, sir.
Thank you, Sandeep. A very, very good evening. Am I audible?
Yes, yes.
President of the associations, Sri Rammohan Bhave, very old friend. Our friendship goes back almost 20-25 years because of the institute, and a couple of times, as he said, we met in the conventions and conferences. Speaker of the day, Mr. Ankit Goel, and the other members here, and also the members who are present here to listen to the expert speaker. A very, very good topic. Unless people had this knowledge of that the International Valuation Institute is there and they come out with standards, I think many people don't know about what is IVS 230 and all that. So it would be a good insight to a lot of people. And during my presidency, I tried for a partnership, for an MOU with the International Valuation Institute. I left it at that, but I think we could not go ahead. Now I'm not sure whether we had this. Considering the importance of valuation, which has been reiterated in the Companies Act 2013, which, when it was enacted, and after that the review was made because of a lot of issues that were there in the first one that was given. So I happened to be, and also fortunate to be associated with the amendments that have come at a later stage. A lot of good amounts of amendments have come. That time itself, Bhaveji, you rightly said that, the government was very keen to pass this Valuation Act, but somehow it got bogged down. The Insolvency Act got upper hand and then it went through. As you said, we can hope that shortly it can come. I would not dwell with the subject of inventory right away because the speaker is already there. And in India, I think we already have Ind AS 2, and from our institute, CS 4 is there, which deals with inventory valuation in depth. So how it differs from IVS 230, when I went through the draft note, I could not lay hand on the final standard that has come. The approach that has been given is slightly different, but I think the principle and the objective of the valuation remains to be the same. While we talk about the standard, they are all guiding forces. I'll give you my own experience. Way back in '92, one of the Hyderabad case companies, which was very, very large company for Hyderabad, an opportunity was given to me. That was my third year of practice, and then I gave up my certificate of practice and I started my company's financial services, predominantly to organize and advise people the requirement of funds and the structuring. So I happened to bump into this company, and one of the opportunities that was given was the chief financial controller was a cost accountant, and he was very keen that a cost accountant does do some job for them. 14 companies of these particular holding companies, requisition was made to me to merge them. Give a proposal, valuation to merge them. And those days, you have to go to the court, and the merger has to be approved. Even the valuation has to be approved by the court itself. If they find that there are something, it can come back. Luckily for me, when I did the valuation with whatever norms that they were available at that particular day, there were no guidance notes, except that how the valuation is done. Whatever we have studied in the books, and some guidance that was there from the seniors who used to do the valuation. And this my first certificate was approved by the court. It is, and court accepted the valuation. This is way back in 19 November, October, November. Since then, wherever I had been associated with, I've been associated with a lot of public issues and the calculations of premiums before the act and prior to the SEBI also. There were lots of restrictions to valuation. The formula was different, and I've been fortunate to be associated. Having said that, the current challenge of valuation, this before the start of this program also I was telling, valuation of inventory is a very dicey subject. If not properly handled, that is the one which increases or decreases the financial statements or financial profits of it plays a very, very important role if not properly handled. Well, the principle remains the same that market cost or market value, whichever is less. But I think I don't have to elaborate as to what happens to it. But since the meeting is being attended by all professionals, whether it's from CA profession, or CWA profession, CMA profession, or CS profession, or even any other profession that is there, we should stick to the principle for which we have been given the job. Compromise on that is going to not only create problems for us, but also the profession in which we are. I think I don't have to stress as to what is happening today in terms of whatever is being, what is being done by the government in different compliances where we as professionals are involved. I think that much hint is sufficient. The second important things which we need to bring to the people who have come into this valuation profession are the new age companies. For example, for the plant and machinery, we have guidelines. We have bottom-up approach, top-down approach. We have different approaches defined already for those plant and machinery, or any of those fixed assets. For land and buildings, land there is an approach. For buildings there is an approach, and for machinery, depending on the life, there is an approach. But these new age companies where there is absolutely no fixed asset. I was reading an article where somebody has compared the valuation of HUL, Hindustan Unilever, to Zomato, which has just been listed. In terms of assets, if you look at, MRF has been compared, HUL has been compared, and Zomato has been compared. Both MRF and HUL, in terms of physical assets, also have assets to the tune of 20,000 crores and all, and the market capitalization, if you really look at the valuation, they were around the 20 to 23,000 crores or something. Whereas Zomato, with no asset to it except for the intellectual asset, I think I don't know tell you what it is valued today. People are now talking about Byju's, which is going to take over every big group that is there in this country. When once it is valued to the extent that it has been, it is being valued in, it is what we read in the papers. So it is very important to understand as to why these companies are commanding. The general parlance, people talk, there is a riff area and it is all a valuation game. It is certainly not just a valuation game. Maybe to some extent it could be true, but that some extent could not be beyond 10-15%. But majority is the perseverance, the perception of the person who is investing into it. I was talking to a lot of VCs because I'm associated with a lot of, I'm helping almost about 15-20 startups today. Every startup promoter who comes to us first talks not about the business model that he has, not about the product that he has, but he says, sir, you have been advising on funding and all other things. What do you think I should get the valuation? So this is the mindset with which these startups come to you for valuation. So if we have to really apply our mind and then arrive at a valuation instead of the traditional models of discounting, cash flow, DCF, or even EBITDA multiples and all, because this one of the major plans that you see for any of these companies today is valuation on the basis of ARRs. It's not that it is new. When I have done a proposal in 1999, one of the supermarkets, the first supermarket that was funded in this country was done by me. I arranged about $2 million for them. The valuation at that time was also on the basis of the revenue. It was not on the profits. There is nothing, it is not new, but the way revenue is perceived today is different from what it was earlier. So that we will be able to understand only when we understand deep into the model with which these companies are working. So in general, when we look at the valuation models that come, very few people talk about business models linked to the valuations. One of my recommendation is to, a lot of companies, they have no choice because the law has laid down that if there is a valuation and somebody is coming and putting in money, if it is less than 5 million, I think a registered value has to certify. If it is more than 5 million, it goes to the merchant bank, that is investment banker has to certify this. So if the first round fundings and the valuations are less than 5 million, that means the registered valuer who is registered with the respective valuation companies need to certify this. So before certifying this, you need to certainly understand the business and then look, after the business model is understood, look into the financial model that is given. I've seen certificate being issued based on the pure financial model, but I think somewhere there will be a problem if that kind of an approach is there. So this is one big learning. I was very happy when Sandeep and Rammohan Bhave told me that you already had a couple of webinars on valuation related to these new age companies, and also there was a panel discussion about the valuation on Zomato and something else. Now the valuation on OA is also coming up. So that would be a very good, interesting conversation to be listened to and understand, because if we go through the standards or you go through the valuation methods, the understanding according to research would be only 50%. But if you listen from somebody, the understanding could go up to 70%. And if you are participating in the discussion and the debate, the understanding could be as high as 85 to 90%. This is the academic research that has suggested. So to that extent, I think we are very fortunate, thanks to COVID. We all are now hooked up to webinars, and we are able to listen to lots of seasoned, experienced speakers from whom a lot of valuable advice and the knowledge sharing is happening. And once a valuation act comes in, there is no doubt that this profession of valuation is going to be to the rooftop. I mean, the demand for values would be such that the current numbers do not just map up to the requirement that is likely to come up. So whoever is eligible and whoever has the wherewithal and the interest in hooking up to this profession, then I think they should complete the valuation examination and then also become member of this association. There are a number of, I think all the 3 institutes have 3 companies where once you get the pass the examination, they are the one who are going to award the membership. But associations will help in understanding and then in networking with people a lot more compared to the usual institutional network. So with these few words, I am very thankful to Rammohan and I think especially Jitendra, who is also present, who has recommended my name to be the chief guest today. I hope we'll have a lot of knowledge sharing from Ankit, who has been spoken very highly in high esteem by Rammohan, and I'm also eager to listen to him. Thank you very much, and have a very wonderful knowledge sharing session this evening. Thank you.
Thank you.
Thank you, sir.
Now our member Sejal Agarwal, who is CS Insolvency Professional and Registered Valuer, will give brief presentation on our association.
Yes, thank you. Thank you, sir. So, is screen visible?
Yes, yes. Okay.
Yes.
Come to first slide.
Yes. Yes. So, good evening, everyone. This is Sejal Agarwal. Thank you, Bhave sir and Sandeep sir, for giving me this opportunity to present this presentation. Now, what is AVP? Association of Valuation Professionals. This is an association that has been mainly founded and formed by Mr. Rammohan Bhave, that everyone knows is president of AVP. The sole objective of AVP is to work in national interest in professionalizing valuation as vocation. So what is the mission of Mr. Rammohan Bhave? He is having a global vision wherein he aims to educate, train and equip either students or professionals from the root level to the proficient level. So his initiative is really appreciable, wherein we all are getting benefited by joining such wonderful association. So kindly do join the same. So now we are having certain tie-ups with AVP. So first tie-up is with IIV RVF, that is IIV India Registered Valuers Foundations, and second is with SME Chambers of India. So for being a member of AVP, we need to just pay rupees 5,000. That is one-time membership fee. As Mr. Ramon Bhave already told, that we need not to pay any annual fees. This one is not only for valuers, any professionals who is interested or who wants to enrich himself in valuation can become a member. What are the milestones achieved by AVP? We have already tied up with IIV RVF for CP hours. That means if you want to have CP hours, you need to pay 1,770 rupees and you can have a CP hours by attending the webinars held by AVP in joint association with IIV and RVF. We already have 150 members. That 150 members are not only from India. We are having foreign countries members also, as already told by Mr. Bhaveji, from Canada, from Dubai, from London, and many more. So we are also having very iconic personalities like past presidents from ICMAI, internationally well-certified valuers, and very prominent speakers. We have already published e-newsletters and one independent special newsletter. We have already conducted 35 webinars with very different topics and with enriched knowledge. So as I already told, we are having tie-up with IIV RVF. That is a foundation that is registered by IIB as RVO. So we are having tie-up with that. We are having tie-up with SME Chambers of India also. That is probably mainly handling manufacturing, service sectors, and allied industrial business sector services. So one question that remains in mind, that why we should join AVP. First of all, it's a life membership fee only for 5,000 rupees. Anyone can afford. We are going to have a free webinars, at least 2 in a month. So you can enrich yourself with the knowledge of valuations. We can have a mentor. You can get a mentorship from Mr. Ramon Bhaveji, and you can enrich your knowledge very well. You can participate in various committees, activities, and you can attend international webinars also. We are having very good networking here, so you can just enrich yourself knowledge and have a good networking also. Knowledge sharing is also one of the main motto of this group, and CP hours can be credited in case if you wants to. So we have already fixed the deadlines up to 16 September 2022. Yes, we are already in advance booking of webinars to be held up to 16 September 2022. So by this, we can see that how dedicated we are towards working, knowledge sharing, and enriching ourselves and others. So by this, I end up this. I hope you all join this group so that you can enrich yourself very well. For any of the queries, kindly contact Mr. President Ramon Bhaveji. The contact details are here. For any membership assistance, Resource Committee Head, Mr. Nitin Brahmaji. And for webinar related queries, Professional Development Committee Head, Mr. Sandeep Agrawalji. You can have a screenshot and directly contact for the same. So that was all for the presentation of AVP. Now, I truly warmly welcome Mr. CA Ankit Goyalji, our today's speaker for the same.
Thank you, Sejal. Thank you so much for the welcome.
Yes.
And
wait a minute. Let me introduce. I need to share screen share.
आपकी तारीफ में कुछ शब्द तो कहने दो अंकित जी उसको.
Sorry. Okay. So I really warmly welcome Mr. Ankit ji. I am extremely overwhelmed to introduce him once again. As I already introduced him earlier, Mr. Ankit ji is a practicing chartered accountant, registered valuer, LLB, ID, and DISA. He is the holder of various other certificate courses from ICI like indirect taxes, valuations, anti-money laundering laws, forensic audits and fraud detection, forensic audit and fraud detections, and concurrent audit. He is an experienced partner with a demonstrated history of working in financial services industry. Skilled in business and asset valuations, insolvency and professional law, debt restructuring, direct and indirect taxations, transactions advisory, and audit and assurance. Mr. Ankit Goyal is a founder partner at AAA Valuation Professionals LLP, registered valued entity recognized by IBBI for all three value asset classes. His valuation firm has conducted valuations of assets for more than 25,000 crore rupees. He is founder partner of AAA Insolvency Professionals LLP, the second firm to get registered with IBBI as an insolvency professional entity. He is also managing partner of AAA AG and Company LLP, chartered accountants, a CA firm with 26 years of experience. He is also director of AAA Capital Service Private Limited, a company engaged in legal process outsourcing services under SARAFSI Act. Further, he is a regular speaker for insolvency valuations and forensics audit subjects at various forums and a guest speaker at various valuable platforms like ICI, banks, companies, and at various other public forums. Now I request our honorable speaker to address all and cast the light of his knowledge upon us. We would be delighted for his expertise and knowledge in every way possible, sir. So without consuming any more time, I request you to kindly address the audience and enlighten us with your enriched knowledge. Warm welcome, Mr. Ankit.
Thank you so much, Sejal. Thank you so much. Thank you so much, Bhavi sir, for the nice words that you always speak and for the laughter that you create in the process, engaging everyone thoroughly. Thank you so much for to Durga Prasad ji for enriching us with his sharing of the importance of this subject. And if we talk about chartered accountants, if we talk about the professionals in our country, inventory valuation is something that is very important for everyone to understand and for standards to be. I will just request Sabu Augustine ji to mute himself, or maybe somebody else to try and mute him. So the idea is to, of course, understand what is this IVS 230 that has been introduced as part of the newest IVS series or IVS revision that has come in. The IVS, the new standards, are compulsorily effective from 31st January 2022. But the same article, the same standard says that one as a valuer can always start using the new standards prior to that date, and it is perfectly permitted for all valuers to start using the same for this purpose. The idea behind this standard is that IVS perhaps thought that there is no standard on inventory, and the inventory at various times is required to be done a valuation for. And in the absence of any standard, it becomes the choice of the valuer to give a number to it. And they have also identified the IVSC has identified certain unique character of inventory, which is important for us to understand. And those differences are what we need to take in account when we are valuing inventory, and when we are comparing that valuation with the book value of the inventory standing in the financial statements. So they have at many places in the whole standard talked about how the book value and how the valuation might be different and what are the reasons for that difference. They've also talked about various methods through which inventory can be valued. We will also talk about practical aspects of inventory. So for that, I will request all the participants to engage themselves throughout this session. And I will keep asking for questions, for queries every half an hour or so. And we will have, therefore, an interactive session, or try to have an interactive session instead of a monologue from my end. That is how it also becomes a better learning session for me. It is already a learning session for me, because each time I talk about this, it is a new learning. Something or the other is what I get to know afresh. Before we talk about the importance of IVS or what is there in IVS 230, we must talk about and revisit our dedication, our respect, and our reason to comply with IVS, and maybe to spend more time on reading IVS as compared to what we might have spent in order to make sure that our reports are compliant with IVS and we are not violating them. And therefore, I always try to talk about why is it important. So we talk about Rule 8.1 of the Company's Registered Valuers and Valuation Rules 2017. And in there we say, and it is very clearly written, that the valuer is supposed to shall follow while conducting a valuation. He should comply with the valuation standards as notified or modified under Rule 18. In the recent interaction that we had with the stakeholders, we understood, and I understood, that these valuation standards, a particular set has already been drafted and recommended to the MCA, and it is maybe perhaps on their table for further recommendation to the government for this notification. And maybe prior to that, they will also like to circulate these for popular opinion. But the proviso to this Rule 8.1 says that till the time a valuation standards is notified or modified by the central government, the valuer shall make valuations as per internationally accepted valuation standards. And it says valuation standards adopted by a registered valuer organization. So the international valuation standards drafted by IVSC or published by IVSC is understood to be an internationally accepted valuation standard, and it is also adopted by various RVOs, including many RVOs have adopted the IVS as the valuation standards, and they're also featured as part of the member institutions of this organization. The code of conduct further, the code of conduct which is part of the rules and regulations, also talk about how the valuer should carry out the professional services in accordance with the relevant technical and professional standards that may be specified from time to time. Standards are very, very important. Standards are important because if there are no standards, nobody can say that a person should have done something which they have not done. So if a valuer is expected to maybe, check on 5, 6, 10 things in his valuation report, maybe disclose certain things in his valuation report, how will that responsibility come to the valuer? It has to be written somewhere, and it is not always possible to write such detailed technical standards or technical requirements in the rules itself. Therefore, there is a delegation that yes, the rules will say, or the company's registered valuers and valuation rules will talk about the valuer's requirement to follow standards, and the standards will be, of course, published by somebody else, which IVS has done in this case. So that's basically the requirement here. Then, of course, we also need to understand that it is not only important for us to follow these standards in our own report. In case we are doing a report, signing a report wherein we have asked somebody else for an expert advice because maybe we are not qualified for that asset class, which has a bearing on the valuation of the asset class that you are valuing. So say you are valuing the shares of a company, and the shares of the company that you are valuing, the company includes maybe a land parcel which is owned by the company. In that case, perhaps it is completely okay for you to go to a land and building valuer, ask him for the valuation of that land, and then make that report part of your own report, or add it to your report, and then derive a value of the shares basically based on that. But then what happens, and what is important here to be understood, is that you continue to be responsible for that other report that you have procured. That is what is written in Rule 8.2 of Registered Values and Valuation Rules. And that is something that we need to make sure. So what is important now? It is not only important for you to adopt the standards that are part of in your own valuation report, but also make sure that the valuation report that you got from somebody else also complies with all the standards. Possible effects: you can pay a penalty, you might have to refund your remuneration, you might have to pay for damages, you might have a cancellation or suspension of your registration as a valuer, You might have a complaint against the registered valuer by any agreed party or any party which wants to create some nuisance. They can easily file a complaint with IBBI or the future regulator, whoever it is, and take you for a ride. So make sure that your valuation report is compliant with standards. Otherwise, it will be a very, very easy thing for anyone to do against you. But wherever your report is having everything is complete, there, of course, it is difficult for anyone to take take the valuer on a trip. So yes, these are the standards. Basically, 101 talks about scope of work, 102 talks about investigation and compliance. Reporting, of course, is IVS 103, basis of value, valuation approaches and methods. If you still don't know the difference between the base of value, the valuation base, the valuation premise, the valuation approach, and the valuation method, you need to, of course, go through the valuation standards, make sure that you're able to differentiate between these four concepts, because all these four concepts are also required to be part of your report. And in case you're not differentiating these accurately, then maybe you're not complying with the IVS anyways. So these are the general standards required to be followed by everyone. These are the specific asset standards, which are of course required to be followed in case the asset class qualifies to be the relevant topic or the relevant heading. So business and business interest, you have all these, and yes, inventory is the newest one on the list. It's called IVS 230. Coming to what is there in the IVS 230. IVS 230 talks about all these things. And yes, what are these? We talk about this is a standard system of the IVS to lay out the contents in this manner. Starts with an overview, the introduction, the basis of value, the evaluation approaches and methods, market approach, income approach, cost approach, special consideration for inventory. So all these are parts that we will discuss as we go along. In case we read the overview, the idea is that the principle contained in the general standards apply to valuations of inventory and valuations with an inventory component. So this standard contains additional requirements for valuations of inventory. What are the primary requirements? The primary requirements are already there in IVS 101, 102, 103, 104, and 105. Whatever is written in this standard is over and above that and is supposed to be read with those respective standards. What do we understand by apply to valuations of inventory and valuations with an inventory component? What do you mean by valuations with an inventory component? So valuations with an inventory component therefore means the example that I took shortly back, that if you're valuing shares and you're valuing market value of shares, you need to assess that what is the value of inventory which is part of that company that you're trying to value. In case you're valuing it at using a basis which requires you to recognize that inventory separately. In case that inventory is already part of work in progress, already part of the working capital, and you are taking care of the working capital assumptions, then maybe you don't need to do inventory separately. But in case, yes, you feel that no, inventory is a significant part and it has a different status, then the inventory component needs to be valued as part of whatever you are valuing. So when you look at the introduction, it talks about what inventory includes. So it says inventory broadly includes goods which will be used in future production processes. Then it gives you examples of these, that's raw materials, parts, supplies. Then it says goods used in the production process, that is work in progress. And then it talks about goods awaiting sale, that is finished goods. So these are the parts of the inventory or the inventory which is part of which is basically defined as inventory. So it includes goods which will be used in future production processes, goods used in the production process, and goods awaiting sale. So these are the three parts. Then it says that the standard focuses on valuation of inventory of physical goods that are not real property. What do you mean by real property? Real property in IVS means immovable property, the way we could talk about in India, or real estate, the way we talk about in India. So real property is valued where it says real property is supposed to be valued by you using IVS 400, because this standard is talking about not specific about land and building assets. So if you're talking about a land and building asset, please go to IVS 400. Look at how you want to value the land and building asset based on whatever they have IVS has written or IVSC has talked about in IVS 400. And that is what one is required to see. IVS 230, they say, is not meant to value immovable properties. So in case you have a business of a real estate, you have a real estate business, and your inventory comprises or includes real estate assets, then it says don't stay here, go to 400. We are not dealing with those assets here. Then it talks about the difference between book value, historical cost, and all that. So it says that while the book value of inventory only includes historical cost, the profits earned in the production process, which reflect returns on the assets utilized in manufacturing, including working capital, property, plant and equipment, intangible assets, are not capitalized into the book value. So as a result, the market value of inventory typically differs from and is usually higher than the book value of inventory. So all my fellow professionals here will agree that when we talk about historical financial data, we never look at inventory at a market value. We always say that the inventory is supposed to be valued at cost or net present value or net realizable value, I should say, whichever is less. And that is what you normally value inventory as. And therefore, you normally never therefore take any profit percentage on the inventory that is with you. But ideally speaking, in case I say that, okay, I have an inventory on 31st March 2021, and let's say that that inventory is maybe, a finished iron rod, or maybe I am in the business of, various production processes, including making that rod. So now maybe I have already entered or already completed significant part of whatever I was supposed to do to make that product come to the stage where I was supposed to get it. And maybe some work is pending, maybe some last part is pending. So other than that, maybe I can look at the market value of that inventory, in a sense that one way of looking at that value of that inventory is that, oh, I bought it for this much, then I've incurred this cost on this cost on this cost on this, and therefore today my value is this much. The other way to look at that inventory is I say that, okay, this will be sold for this much. And if it is sold for this much, then I will remove the further costs that I'm supposed to incur to complete this asset. And therefore, I will then give the balance amount as my, maybe the balance amount as my inventory value or market value. So the problem that it talks about in 20.4 is that the inventory is seldom transacted at an interim stage, for example, at a work in progress stage, and or may not be frequently sold to a third party to conduct the selling effort. And the valuation technique and considerations for inventory frequently vary from those of, therefore, other assets. Then, of course, it talks about inventory valuations are performed for a variety of purposes. And of course, you can keep repeating this, that value's responsibility is to understand the purpose of the valuation and whether the inventory should be valued, whether separately or grouped with other assets, and so on. So, non-exhaustive list of examples below, then it lists down all these. This is the risk combination and impairment assets. Then it talks about transfer pricing analysis, estates and gift tax planning and reporting, and ad valorem taxation analysis, litigation, requiring valuation analysis. Then talks about general consulting, collateral lending, transactional support engagements, and insolvency. So all these things are required to then basically these are the requirements for valuations, for which, purposes for which valuations might be required. What is the basis of value? Can anyone tell me, unmute themselves and tell me the various bases of value that are available as per IVS to the valuer?
Market value, investment value, synthetic value.
Very well, SK Jain sir. Thank you so much for that input. And these are indeed the options that are available. So these are some basis of value. And What IVS 230 does, it does not say the basis of value that is popularly to be used for inventory. It says that yes, you choose the appropriate basis based on whatever valuation you're doing. So in case, say, maybe you're doing a valuation for the purpose of a transaction to be entered between A and B, where you're consulting A on how much value should he give for the business. In that case, or in how much value should he give for the inventory, perhaps. So in that case, you might follow a market value, because you might want to understand that, okay, what is the market value of this inventory today? In another case where maybe you're looking at, say, equitable value, there you know that, yes, this business is being transferred to this person, but then you're maybe more sure on how the goods will be completed and how the finished product will be available to the buyer of the business for sale in the market. And in that case, maybe you can value the inventory differently under an equitable value basis. Coming to valuation approaches and methods, so it talks about how the 3 valuation approaches described in IVS 105 can all be applied to valuation of inventory. And it says the methods described below simultaneously exhibit elements of the cost approach, market approach, and income approach. What are the economic principles on which cost approach is based? Can anyone tell me? Economic principle which is used to value an asset based on cost approach. Income approach, anyone? Sorry, Sangeeta ji.
Cost approach essentially means that you cannot value inventory more than the cost that you have incurred in bringing it to its current state.
Economic principle of substitution, where you say that, okay, if you want to substitute this asset today, what will be the cost that you incur? Market approach principle is price equilibrium, where you say that, yes, if this is valued at this much, then this should also be valued at this much. This is the economic principle you follow for market approach. Income approach, you say, what are the anticipation of benefits in the future? What is the anticipation of benefits and costs in the future? And what, therefore, what is the present value today? That is the focus on income approach, where you anticipate future benefits and give a value to some asset or something because of the future possible income that will generate, right? So today, in case somebody talks about Zomato share, where is it deriving its value from?
Income.
Sorry? Income. Of course, you can have different thought processes. One can say, oh, there is a company which is listed in the US which does similar business. Let me then compare that company to this company. So in that case, what you're using is income approach, market approach. So say you say, no, I want to expect, I am very confident that Zomato will make this kind of money in the future. So the income approach is what then perhaps you might use. Cost approach, you might want to say that if today you want to build a brand and an app and all these networks, all these intangible assets that they have, that there are these many connections, these many users, if you want to reach here, what will be your kharcha, what will be your expense? That will be a cost approach. So the idea is that when you're valuing inventory, it says that you simultaneously do all the things, right? For inventory, you might look at cost approach for maybe a raw material item kind of a thing. Maybe you are more comfortable with market approach, where the item that you're supposed to value is already available in the market and widely available in the market. And maybe in some cases you might look at the selling price, and then you might look at the income approach. So it can be a simultaneous approach. Then it says that if necessary for the valuer to classify a method under one of the 3 approaches, the valuer should use judgment in making the determination and not necessarily rely on the classification below. And then says that while selecting the approaches and methods, in addition to whatever he has discussed in 40.1, the IVS says that you must go to IVS 105 and make sure that you're complying with all the provisions in the IVS that talks about approaches exclusively. Coming to market approach. So the market approach, in other words, reference to market activity involving identical or similar goods, it says has only narrow direct application for the valuation of inventory. And it says that such applications typically include inventory of commoditized products and inventory in which a market exists for the inventory at an interim stage in the production process. So can you give me some examples of commoditized products in the Indian scenario?
Would be like FMCG products.
FMCG products. Okay. Any other inputs?
Or example could be a sugar or
Sugar, I believe, is a very well commoditized product because it is perhaps traded also. It is also listed on commodity exchanges, futures, and all that, right? And therefore, there is a ready market. So today, in case some random person wants to say, "Oh, what is the price for sugar?" Maybe you can search it on the net and find a few exchanges where the price is readily available, right? Of course, there can be little differences because of the quality and all that. But then, on a broad sense, per ton value, per kg value will be a particular value. Any other examples of commoditized products like sugar that we talked about?
Metals.
Lentils. Okay.
Metals.
Metals. Okay. Metals. Yes. Metals are, of course, commoditized products. Yes. They have.
Jewelry.
There is a rate card. It's not that, okay, somebody will call up SAIL and Tata and Jindal and ask about the price. The price is fairly publicly available. Jewelry, no. Maybe jewelry is not a commoditized product, but yes, gold certainly is. Maybe if some. Yeah, silver and gold, perhaps precious metals, as I can say, maybe they are commoditized products, but otherwise difficult to say that jewelry as a whole is a commoditized product. And copper, yes, as you said, metals. So, all these ferrous metals, non-ferrous metals, aluminium, copper, and all that, all these, their alloys, these are fairly commoditized. So if somebody says that, okay, I have, this kind of, this grade of steel lying with me, this grade of titanium alloy lying with me, then we can say that it's a commoditized item and I can try to find the market price today and give it a value, right?
So, crude oil also a market product, sir?
Which product, sir?
Crude oil.
Crude oil again is a commoditized product, sir. The crude oil, there are maybe, Brent fuel, there are other grades of crude oil again, but then yes, there is a possibility of finding a price and it is a fairly commoditized product. So what about the second part where, you feel that the inventory in which the market exists for the inventory at an interim stage. So any interim stage item that you remember where, you feel that there's a market for that interim stage item? Anyone?
account base. I have given the example of sugar. So molasses would be something interim product. So,
yes, very well. So molasses is also used in the same factory at times. Molasses is also sometimes then sold to fertilizer industry for further processing at their end by the factory which is not processing it. So very well said, Harshadji. Any other
Petroleum products.
Sorry, Sugnaji?
Petroleum products.
Petroleum products, are they used within the are they used
or all these?
But are they used within the refinery after making them?
They are sold as intermediate products.
So
by-products in the process, manufacturing process. All by-products.
Okay, so coming to back to the petroleum items, of course, crude oil is refined and various items from crude oil are extracted. And yes, some of these items are then used for a further process where perhaps, they are converted into some petrochemical products. And at times, maybe the factory is integrated enough to, yield out a totally different petrochemical product. And at time, maybe the factory is just taking out that kerosene and then, selling it into the market. So I think that way Sagunaji is right that yes, there are integrations that have happened in larger petrochemical plants where yes, it kind of is consumed readily at times. And with respect to the other part, which I think Jain sir said, what did you say, sir? What were you mentioning?
Byproducts in the manufacturing process.
Byproducts. So maybe we can give any specific example that you have in mind. I have one example of called iron billets, right? So iron billets are also used readily into the same factory, and then they're also, of course, an intermediate product which many people sell and buy in the market. right?
Would products manufactured by original equipment manufacturers that go eventually with component manufacturers, that eventually all of these components go eventually to the manufacture of one whole product? Take for instance, automobile components or aircraft components.
But do you really think that they have a market? Like, they don't have a market, right? So the idea is that the interim stage product must have a market for themselves. So in case maybe somebody is manufacturing hinges for Maruti Suzuki, is there a market for those hinges outside Maruti Suzuki? I don't think so. So the idea here is that in case you want to,
I would say yes and no, for the simple reason that some of these engines are used commonly between several automobiles. So if one doesn't buy, the other can buy. Similarly,
do they? So is there a system where Maruti Suzuki is buying some engine which others are also using in their models? I'm not aware of it. Maybe others can also confirm this.
I think
they talk of a common platform, right? Several automobiles use, for instance, the Fiat engine.
Yes.
The Fiat is a brand of an engine, and several automobiles use the Fiat engine.
But in my opinion, even there, they want certain tweaking to happen into that engine before they use it for their particular model.
Fair enough, understood. Yeah.
So maybe it is not a commoditized item where I can try to find the market prices, because there will be no trading, there will be no public data available with respect to that engine that I can use to value that inventory. That is the point that we're talking about. That there has to be some information available on, public platform or public data available on that item which we're talking about that is being traded in it at an interim stage.
Okay. So those engines are not traded at in the market. They are specifically made to be designed.
So maybe, if they are not being bought by Maruti Suzuki, they will be bought by one or two other
the engines,
car makers.
Some engines are common between Tata, Fiat, and Maruti. But for Maruti, whatever share is there, those engines have to go there, and they are cannot be traded in public, or you keep them in the market. And whether Maruti picks up or Tata picks up or anybody else picks up, then it's the market commodity. It's not like that.
Understood.
So that's the idea here. That is what the IVS says, that you identify first whenever you're trying to use market approach, you try to find out that, okay, that it says that mostly, these products or the inventory items are specifically made, but at times you might have a commoditized products which you have available in the inventory. You might have an inventory in which the market exists for the inventory which is lying at that interim stage. And it says that yes, for non-commodity traded products or products that market the products that market exists at an interim production stage, such as selling prices must be adjusted down. That wherever you find a market priced item, you must take care and make sure that because the inventory is lying in the factory and the disposal costs are yet to be incurred. Disposal costs can include packing cost, disposal cost can include the cost of distribution, the cost of setting up a distribution network, selling that item really in the market. Maybe you're selling a sale team, your order receiving team, and so on. So those are selling costs, disposal efforts that are required. So make sure that whenever you're looking at maybe a gold price in the market, that yes, that gold price is there in the market, but then to get that price, you might have to incur say 5% of that value. So therefore, that must be reduced when you are understanding or computing the selling price from that, or deriving the selling price from the market value. Then it goes on while the market approach is not direct. The items are not commoditized, the items are not interim stage items, and so on. Say you find in the inventory maybe some alloy of aluminum and zinc, and you say that okay, this has a certain weight, and maybe it is a component that has been manufactured using forging, or which has been manufactured using, it is a sheet metal component, whatever it is. The idea is that its weight, if you weigh that one item, one sample that you have in your hand, and you know that the prices of zinc and aluminum are maybe XYZ, you can estimate that yes, that component should be of a certain value after incorporating the cost of conversion or cost of reshaping it to that shape, because the primary element, underlying element inside it is some alloy, some metal. So anyone who has something to add on to what I said, because I hope this is understood by everyone, that whenever you look at any item, there is always some market approach basis that you can derive some estimated value out of that item. So therefore, the standard says that in 50.2, it says that at any point in time, do consider, the valuer must consider the market-based indications to determine the selling price of as an input to other methods also. Then it also talks about other observable markets that may provide insight on the returns attributable to the market manufacturing and disposition of assets that can also be leveraged for inputs other than into other methods. So such returns are typically considered to exclude returns attributable to intellectual property. So they're given two examples where one, they talk about distributor profit margins, where they talk about how these margins represent a meaningful market proxy for returns on the disposition process if an appropriate basis of comparable companies is identified. So the other part is, of course, contract manufacturers, where they say that to the extent available may provide a proxy for margins earned through manufacturing process. So these two examples is where they say that you normally exclude the returns which are attributable to the intellectual property, and therefore in these two examples they say that if you are having a distributor profit margin in the industry, and you know that yes, even in maybe you are using your own distribution team and you don't have a distributor, but you understanding the distributor profit margins can carve out that value out of your own selling price. Similarly, in case you have contract manufacturers in your business, then the margins that those contract manufacturers are keeping is again something that you can carve out and deal with. Then valuers must comply with the paras 20.2 and 20.3 of IVS 105. So basically talks about market approach, and then market approach when determining. So basically the idea is that you must test the method for under these two paras before applying the market approach. And in addition, valuers should only apply the market approach to value inventory if both of the following criteria are met. What are these criteria? First criteria is that information is available on arm's length transaction involving identical or similar inventory on or near the valuation date. The second one is sufficient information is available to allow the valuer to adjust for all significant differences between the subject inventory and those involved in the transaction. So these are very, very standard items. These are also part of IVS 105, but with respect to inventory, they have added these two items, and therefore these are the things that you must take care of when you're using market approach. Then they talk about how the evidence, wherever it is available, the valuer should make adjustments to these to reflect differences between the subject inventory and those involved in the transactions. And it talks about how such adjustments may only be determinable at a qualitative rather than quantitative level. And therefore there might be a challenge or a need for qualitative adjustments, where if the need for qualitative adjustments is too much, then it says that you may try and then follow some other method and leave the market approach, because in case the qualitative adjustments are too many, then to quantify them, to give them a value becomes difficult. Any questions on market approach? Any questions on anything that I have discussed so far? So maybe if somebody has any question, anything to contribute, you can share.
One question that I have always had in my mind is, according to the valuation rules, a valuer is supposed to adopt a valuation standard. And until such time as the rule, I think rule 8, right?
Yeah.
Until such time as the valuation standards have been adopted or have been notified, the valuation standards, any international valuation standard can be taken, And does it say or does it say and any valuation standard adopted by an RVO? Is it a choice of or is it and?
It doesn't say and or, interestingly. It only says,
I noticed that.
it says nothing. So basically the idea is that, in my opinion, and the way I read it is that in case your RVO has adopted a standard, and let's talk about, say, ICAI RVO. Say ICAI RVO has adopted ICAI valuation standards, which are perhaps the only standards which are Indian standards. And if you're complying with that, you can't comply completely with an internationally accepted valuation standard, because the fact is that ICAI valuation standards don't have any international acceptance per se. But then maybe, we can say that yes, ICAI RPO has adopted them, and therefore we are covered under Part B, and therefore we are complying with this Rule 8.1. Now, in case I talk about, say, IVS and say that, okay, maybe ICMA RVO or IOV RVO, other RVOs have adopted IVS as a standard, there is no contradiction, because internationally accepted valuation standards include the IVS as well. So therefore there is no contradiction. In that case, if you are complying with IVS, then you are complying with A as well as B. But for I don't think there was an intention to create a difference. So the idea is that if the RVO has adopted an Indian standard, let's say the RVO is ICAI RVO, in that case, can I say that ICAI RVO is internationally accepted valuation standard? Maybe it is derived from all those, but it may not be an internationally accepted valuation standard. So the idea is that the conflict, it is, synergy, but other than the ICAI valuation standard part, and that standard is also very, very close to IVS, except for minor differences here and there. This is the best I can talk about this subject, because and or I don't know whether it is and or. And
I understand. No, that's been a point of confusion
and
for me.
I think it can be read as and wherever it is feasible, and wherever it is not feasible, it has to be read as or. There is no other option.
More often than not, it would be interpreted as or.
No, I'm saying that there is only conflict with one RVO in the entire country.
Correct, yeah.
Because so the others, there it can, even if you read it as and, there is no conflict.
Correct.
Yeah.
So for those the first one,
I think that is also interim problem.
Sorry. Harshadji was saying something perhaps.
That is also interim problem, because soon that committee under Rule 17 is already.
Yeah, let's hope soon we have a good new customized standard for our own country. Yeah, and looking forward to that as well. Any other questions from anyone
my
else?
question is about that same that inventory. It falls under which asset domain? What is your view? I know that this is a very Pandora box question, but I would like to listen.
It's not a Pandora's box question, in my opinion. I think it's a very, very valid, a very, very genuine question from you, and for everyone also, because many people, when they are valuing assets and then they're differentiating assets, or rather classifying assets between different valuation professionals, the question is that who will value this? And frequently inventory has no takers, and in other situations inventory has a lot of takers, depending on whether somebody is paying additional fee for the inventory or not. So the idea is that if the inventory is land and building nature, then land and building valuer should value it. If the inventory is plant and machinery in nature, certainly the plant and machinery valuer should value it. Now, traditionally, what has happened in our country is that inventory has been valued, maybe not valued, but at least audited by chartered accountants. So we naturally feel, chartered accountants and all the SFA valuers feel that no, it is our domain, although it is a tangible asset, and so the certain parts of valuing inventory which a chartered accountant or which an SFA valuer is well equipped with. So in case you talk about maybe understanding the cash flows that will be generated in future from the sale of the inventory, in that case, perhaps yes, the plant and machinery, land and building valuer can also be equipped about it. But if the inventory is, say, coal, now if what I have in my inventory is coal, can I say that yes, a chartered accountant is an expert in valuing it or quantifying it understanding how much is lying at a particular place. Maybe yes, maybe not. So therefore, there is something called volumatic analysis, which is used to value, such items which are of high volume or which are lying somewhere. And maybe a plant and machinery valuer who has perfection or who has experience in volumatic analysis is better off in giving a value to this coal inventory, and maybe then estimating the price. So it totally depends on what asset we're talking about. And then if somebody is there who is having a specialization in that particular item, then that is certainly preferred.
Another sticky item could be valuation of livestock.
Yeah, valuation of livestock. So the idea is then whoever is valuing it, can I expect land and building or plant and machinery valuer to have the expertise in going to the market and hunting for prices of that particular breed of cow? Maybe not. And do I say that an SFA valuer has the expertise in doing that? Maybe again not. So maybe somebody will have to approach a specialist who has some experience with livestock valuation and identifying the breed of that cow that you're trying to value. Anyway, these are very, 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 one-off and very, very tricky situations. And I believe that in most such cases, wherever I have come across this challenge, that I'm feeling that I'm short of the mental capacity or the experience with respect to doing a particular valuation, I've always tried and done that using the help of an expert in that industry. And I think that is the answer, that that is something that is permitted to all valuers, that they can approach a specialist of a particular industry and do some research, do some market research, and give their own opinion.
So Ankitji, to just, my thoughts on this, if you permit, that there are three categories. I mean, in inventory, I will put it this way: 3 types. One is that raw material inventory. I mean, as is inventory, that traded inventory maybe. Second would be a WIP, and third would be FG. So RM portion that consists of 2 parts. So material inventory, whatever the material may be. So that might consist of 2 parts. One would be that quantity and characteristics, and the second part would be the valuation, whether to FIFO, LIFO, market value, whatever. Okay. So one part is definitely that characteristics, quantity. Perhaps that could be, you can say that PM valuer may have edge in that. Whereas the other part would be that valuation, that FIFO, weighted average, or market price, or any other method of valuation. So that maybe it easy for RM portion, but coming back to WIP, suppose say my own example, molasses. If I want to value the molasses, so whether a PM guy would be a preferred choice, or SFA guy, frankly, as you rightly said, that it's a very tricky question, that and talking about expert. So then who would be the expert? Perhaps, as you say, that in many cases that chartered accountants are auditing this thing, so they proclaim to be experts. Somebody from sugar, this thing, he also proclaims to be expert. And that question gets more complex when it comes to the valuation of WIP and FG, because it consists not only the part of the materials, but a part of value addition, which may be in the form of the labor or the overhead content. And that is where perhaps people may say that SFA as a residual class, but I don't find somewhere in the IBPA books. I have written also to IBPA to clarify. Till date, there is no clarity. So as of now, sometimes SFA as SFA valuer, I do the inventory valuation. Sometimes somebody from PM does the valuation.
Yeah, so I think that's how it will remain for the time being, because till the time there are maybe some additional asset classes which are introduced wherever they're required, it might remain like this. My only inputs to whatever you said is, or the additional items that I would like to say, is that I don't think any SFA valuer has any monopoly on doing a market study or using an income approach. I think everyone, land and building, plant and machinery, everyone can do that. And yes, this perceived thought that no, whenever it comes to income approach or market approach, it is the job of the SFA valuer to do that job. I think is kind of a partial thought, and I think yes, there is nothing which says that no, they are not allowed or not permitted to use income method, the PNM values and the land and building values. So that is the reason why that is the only disagreement I have with your thought process. Otherwise, yes, anyone can do any valuation. So in case there is a say an engineer, a mechanical engineer who has become a plant and machinery valuer and who has a thorough experience with sugar industry, maybe he's a better expert with understanding where the molasses is sold and where from he can get the market prices correctly as compared to an SFA valuer who has no such exposure. So therefore, I said it is very subjective. Maybe it will depend on case to case, and the best person who can do the valuation will depend on the person who has confidence in doing that for the specific industry rather than anything else. Any other questions from anyone else on market approach? Okay, then let's move on to income approach. So the valuation of inventory using the income approach requires the allocation of profit or value attributed pre-valuation date versus the profit or value attributed post-valuation date. And the valuers must comply with para 40.2, 40.3 of IVS 105. So what are we talking about? It says that in case you want to compute the market value of inventory as on a particular date, and you want to use say income approach. So it says that the formula that you should derive, or the idea that you should have in mind is that whatever is supposed to be my profit on this inventory, say it is at a stage where it is where 90% of your effort is complete. So in that case, the idea says that if you want to look at anticipation of benefits, you must say that, okay, I have say I'm supposed to incur say 80 rupees of cost on this item. I'm supposed to have a profit of 20 rupees, and I'm supposed to then sell it for 100 rupees. In case that is the equation, it says that now you have to divide that 20 rupees between what has already been done by you and what needs to be done by you. So in case say that 100 rupees that is supposed to come into you requires a distribution effort or requires a marketing effort, and that marketing effort has not yet been made. So in that case, you remove that from the profit element and then value the rest. So that is the kind of income approach that it is suggesting. Then it talks about two different methods. One is top-down method, the other is bottom-up method. Top-down method talks about, it is also called a residual method. Whenever we talk about a residual method, what do we mean? We basically start with a figure and then keep reducing certain amounts and come to a value. That is what is a residual method, and it also comes sometimes called a top-down approach. So it begins with estimating the selling price and then deducts the remaining costs and estimated profits. So is this, I hope this is clear to you. So let me take an example again. So say that our 80 rupees example, that 100 rupee example, 80 rupees is your total cost, 20 rupees is your total profit, and you're supposed to say maybe do 5 different processes before you come to the final product, and you're already done with 3. So can anyone tell me how will you compute that value of the inventory based on this approach? All the approaches take equal cost and equal profit, equal effort. Let's say for assumption. And you have completed 3 out of 5 approaches. 3 out of 5 steps. Anyone? Can I say that I can value that for 60 rupees? Because maybe I can apportion the profit and all that, and then, come to 60 rupees out of 100 that I have completed. I have incurred the costs, I have allocated the profit, right? So that might be my value for a top-down approach. Then the top-down approach attempts to bifurcate the efforts and related value that were completed before the measurement date versus those efforts that are to be completed after the measurement date. Anyone who can give me an example in any industry that they have experience in where they will like to value the assets, or where they are able to estimate the efforts or related value based on this discussion? So going to the key steps to do this, to apply the top-down approach are estimating the selling price and estimate the cost to complete. Then the cost to complete or the completion cost should include all the expenditures directly or indirectly remaining to be incurred post the evaluation date in bringing the work in progress inventory to its finished conditions. Cost to complete should be adjusted to remove expenses benefiting future period. Then subtract the cost of disposal. Disposal cost generally includes selling and marketing expenses, while procurement and manufacturing expenses have typically already been incurred for finished goods inventory. So then subtract the profit allowance on the completion effort or work in progress for the work in progress only, and then the disposal process. Then you consider all the necessary holding costs, and then holding costs may need to be estimated in order to account for opportunity cost associated within the time required to sell the inventory. Risk may be function of the length of inventory life cycle and the contractual arrangements with end consumers. Holding costs may be immaterial if the inventory turnover is high or the borrowing rate is low. So anyone who has any questions on top-down approach or the logic behind it, anything that you want to ask, please let me know if you have any questions on this. Then it says that when determining the cost to complete, cost of disposal and profit allowance, the valuer should identify and exclude any expenses that are intended to provide future economic benefits and are not necessary to generate the current period revenue. So internally developed intangible, it says, should either be modeled as a cost if they were hypothetically licensed or considered as part of a functional apportionment when determining the appropriate profit allowance. And then it says that when utilizing the top-down approach, valuers should consider whether sufficient data is available, and wherever sufficient data is not available, they might apply the other approach. And then they say that the bottom-up method may be applied by the valuer to corroborate the value derived from the top-down method. Clear? Coming to the bottom-up method, you start with the book value of the inventory, and then you add to the book value of the inventory the cost of buying and holding already incurred. You add any cost towards completion already incurred. Then such costs can be procurement cost, manufacturing expenses, and so on. Then you add profit on the total cost already incurred. Here it says that it is very, very important that you should not make the profit margins proportionate to the cost incurred, because it says that there is frequently in the manufacturing, in the goods space, you might have already incurred about 70%, 80% of your costs or maybe in some occasions even 90% of your cost when you have just purchased the raw materials. So in case you say that my raw material purchase is done, I have incurred 90% of my expenses, and you allocate 90% profit to that effort, and value the inventory, inventory at a particular amount. So it says that be careful that your profit allocation should depend on the work that you have done or the jobs that you have completed in the process of conversion of your inventory into actual sales and realizing the profit, rather than the cost incurred. Because material purchase at times may not involve any effort or little effort, whereas the effort to machine it, the effort to maybe sell it in the market, do something else, might be a lot more. So when determining the costs already incurred, valuers should consider internally developed intangible assets that have contributed towards the completion effort. Any questions on bottom-up approach or top-down approach with respect to income approach? Any questions from anyone? Okay, coming to cost approach. So cost approach, what was the economic principle that we are using in cost approach? The concept of substitution. So we're talking about the primary method. We're saying that the primary method to value inventory is the replacement cost method, and the raw materials inventory is typically valued using current replacement cost method. And of course, you have to comply with the IBS 105 whenever you're using this. Current replacement cost method, it says, may provide a good indication of market value if the inventory is readily replaceable in the wholesale or retail business. Example, say a raw material inventory. So what can you value as a raw material inventory? Maybe you coal, right? If you want to value coal today, you can value it using this method. Oh, how much does it cost in the market? And then you will give it a cost method. But when you are estimating that how much will it cost in the market, aren't you using a market method? So that is what, the standard also says. It says that the market value of raw materials and other inventory may be similar to the net book value of the as on the valuation date, but certain adjustments should be considered. It says that if you want to then adjust it to a FIFO basis, because maybe your books are not showing it on FIFO basis, you should do that. If raw material prices fluctuate, inventory turnover is slow, in that case, yes, make sure that you're making changes. The book value of raw materials may also be decreased to account for obsolete and defective goods. The book value may also need to be decreased for shrinkage, which is the difference between inventory listed in the accounting records and the actual inventory due to theft, damage, miscounting, incorrect units of measure, evaporation, etc. The book value may also need to be increased for any costs incurred in connection with raw material preparation, which is not made part of the book value. Any questions on the current replacement cost method from anyone? Coming to special considerations for inventory. So special considerations of inventory include what? It says identification of value-added processes and returns on intangible assets is a tricky affair. So it says that they have some additional guidance on it. So we need to look at that. Then it talks about relationship to other acquired assets, obsolete inventory. How do you talk about that? Then unit of account. So let us look at these considerations one by one. First of all, we look at identification of value-added processes and returns on intangible assets. So it says the valuation of inventory involves an allocation of profit between the profit earned pre-measurement date and the profit earned post-measurement date. Then it talks about that in practice, profits earned may not be proportional to expenses, as we just talked about. And it says in most cases, the risk assumed value added or intangibles contributed to the inventory pre-measurement date are not the same as those contributed post-measurement date. And it says that the valuers typically should not simply allocate profit in proportion to disposition and manufacturing costs. And this assumption, as we just said, can mislocate profit, as it presupposes that a company's production process earns profit on a pro rata basis based on cost incurred. So we should be careful about that approach. This is what it says. Then the valuers should distinguish between value-added costs and those that are not value-added. And the materials proportion of COGS may not be a value-added cost because it does not contribute any of the profits to the inventory. So procuring the material that you want to use to, do the conversion process to bring the product to the final stage is very rightly said that procuring that is not a big achievement, right? Anyone can do that perhaps, but in using your intangibles, using your know-how, using your machines, using your various processes that you go through to then create some value is what you are actually doing as part of the creation value system. And the value should determine the extent to which the technology, trademarks, and customer relationships support the manufacturing and distribution process, and whether the returns are applicable to the entire base of revenue. Then for marketing intangibles, it says that the determination of whether the intangibles is an attribute of the inventory may be difficult, and to assist with the determination, the valuer must consider how the inventory would be marketed by a market participant to its customers. That is, whether it will be done using a pull versus a push model. What is a push model? Push model requires significant disposal effort. So the company is pushing the product to the customer. Whereas in a pull model, the customers pull the item from the company. So therefore, the pull model does not involve any significant effort to sell the item. And there it says that it depends on a strong brand development and recognition that pulls the customer to the product. So non-exhaustive list of other considerations for evaluating when intangible assets are contributed may include the amount of marketing spend, whether products are sold through a distributor, level of attrition for customer relationships, and any legal rights associated with the intangible assets. Then it talks about how in some cases intangible assets may consist of several elements that contribute to various aspects of the value creation. And it talks about how a pharmaceutical product intangible asset that is comprising of technology and trademark. And it says that this requires an assessment of how the overall profit attributable to each element of the intangible asset should be apportioned to the manufacturing the inventory versus in the disposal effort. When we talk about, then let's talk about the obsolete inventory reserves. It talks about how the value should account for obsolete inventory reserve balances, and the inventory reserve balances should be applied to the inventory in which the reserve applies rather than netted against the entire inventory balance. And it says that typically the obsolete inventory adjusted for the inventory reserves would not be valued as it has been adjusted to net realizable value. However, the valuer may need to consider further write-downs if market value is lower than the net realizable value. Coming to unit of account, we talk about how for the purpose of inventory valuation, it is often appropriate to assume inventory as one homogeneous set of assets, but it says that rather it is possible for the profit margins, risk and intangible asset contributions to vary by product or product group. And it therefore says that if the profit margin, risks and intangible assets contribution vary by product to product group, and relative mix of inventory being valued does not match the assumed sale mix used to develop the assumptions for the valuation, the valuer should assess the different groups of inventory separately. So say you have inventory wherein you have some coal, you have some maybe you have some other items. So you can always create inventory groups and value the inventory based on that. Maybe you have different lines of production. Maybe you're manufacturing Maruti Suzuki Swift as well as Maruti Suzuki some other car, and then you have totally different sales mix or contribution efforts for those different products. So with that, this presentation ends. That is what is written in IVS 203. Any practical aspects that you would like me to discuss about inventory, where you think or you have any suggestions on how inventory should be valued when we're talking about this valuation standard, then we can of course talk about those practical aspects.
Accounting standard, or rather the accounting policy for inventories, the cost or market value, whichever is lower.
Yeah.
Now, in the case of inventories or any other asset for that matter, with the in-AS coming in, shouldn't it now be cost or fair value, whichever is lower?
Not really, because the idea behind inventory, as we just read, is that talks about if you look at the definition of fair value, it talks about what will be the selling price for this item in the market. And the idea is that since inventory is anyway supposed to be part of the working capital of the company, and the company is just stuck with that inventory on that reporting date because it has not been able to process it in most circumstances. So in those cases, expecting the company to go for a fair value computation of that inventory, wherein they will then say, okay, what will this get sold for, what are the costs that we are supposed to incur yet, and then add the profit margins to that item. I don't think that will result into too much of a value addition for the overall process that is supposed to be adopted. So when you talk about other assets, say plant and machinery assets, land and building assets, there the fair value versus the debate in fair value versus cost price is that the cost price will never change for years and years together. So how do you compare a company which has set up its operations recently versus the company that has set up its operations say 40 years ago? So there the argument is that fair value represents the value of the company to the to the stakeholders clearly. But in case of inventory, that making that effort for that inventory every year is difficult. Rather, the stress should be to make sure that all the inventory that you're valuing is correctly valued using cost or net realizable value, and making sure that yes, whatever value you're giving to the inventory is at least realizable and it is not obsolete inventory or stuck units in the inventory. That is something that is already part of the standard. So we don't need to change that for that. Any other questions from anyone else? So let's take on some practical case studies. You have a huge block of coal lying in the inventory of the books of the company. How do you value it? Anyone having such experiences, or maybe others can share their experiences of valuing some kind of inventory, and what method did they adopt to value that inventory? Let's start with coal first. So how do you value it?
Market price, sir.
Sorry?
Market price.
So you understand that yes, maybe you kind of try to find out the grade of coal that is lying there, and then try to estimate the quantity, which is again a difficult step, but then yes, that is what one can do. And then then look at the market price for that kind of a coal or for that grade of coal, and then value it based on that. Yep, fairly that. But then what is important there is volumatic analysis. So one has to take measurements of the height of that coal, the heap of coal, and then the average height, the area that it is occupying. Try to understand that for how long has it been there. The moisture content in the coal is very, very important to understand in case you are able to pick up a sample and then weigh it. If you look at how coal is stored, it is actually lying in the open, and the rainwater is also being fed inside the coal. So the idea is that the weight may not be the actual value, because it might have a very high moisture content because of the rains and because of the fact that it is lying outside. So that is what I believe one can look into. So another case study, you go to a factory, you find some stores and spares lying out there, maybe some machinery parts. How do you value them? What do you ask? What information do you collect to value that inventory, that store and spare, the machine parts that are lying there? Stores and spares, how do you value them? Part of inventory, right? Anyone who can tell me how you would like to value them?
That be part of inventory, or would that be the domain of the P&M?
Okay, so the P&M valuer can perhaps have a better chance to value them, because he might be able to assess that, okay, which of these stores and spares are actually usable, which ones have lost their date of use, which ones are used items, which ones are old items which are just put back into the inventory, which ones are new items. Maybe some other valuer may not be able to identify that. When you do a valuation of inventory in a similar circumstance for a running unit, there you might have help from the technical person who is deployed there, who can give you some kind of an aging, some kind of analysis on how certain parts available with him in the stores and spares inventory are usable in future, and what has been their aging, since when are they there in the stores and spares. So certain guidelines are there. Say you go to a power plant. In case of a power plant, it is compulsory for them to have certain stores and spares available at the premises, because if they don't keep those spares in the inventory, then they may have a malfunction which will take days and years to, perhaps days and months to correct, which they can't afford, right? So therefore, there is always, depending on the industry that you're at, depending on what you are valuing, or which so in case of power sector, yes, you should ideally have a full-fledged stores and spares store, which will perhaps include very, very expensive items as well. Whereas in case of maybe another industry, there may not be that kind of a store and spare store, because there you may have more you may want to then it is easy for you to call up help and get somebody to make that part for you, or get that part from you from the market itself. So say you own a motor vehicle, You will not be carrying any stores and spares today, right? Because you know that you will go to a service center and get the stores spares there. But in case you're talking about a power plant, of course, you will look at the stores and spares. Any other inventory item that you will like me to talk about, or you will like to talk about? Anyone? Sorry?
Also could also apply in the case of the guidelines, for instance, especially the maintenance services, where they necessarily have to keep inventory of critical items. Otherwise, the time is of essence, and aircraft have to be on the run all the time. So you can't have even a minute of outage because
So very well said, Mr. Srinivas, that aircraft industry is also something similar, and they're also then depending on the models, certain parts are repairable, many parts are not repairable, they're simply replaced, and there is normally a contract where the various vendors who have contributed into the aircraft, they keep their stock with them, and then at busier airports they keep their stock, and then they have an agreement with the airline or with the entity which is taking care of maintenance at that place, and then they supply parts at a short notice, or they are responsible to keep that inventory. In certain cases, very expensive items are flown in because it is not possible for them to be kept at the airport itself. Smaller airports, there those parts are brought in with speed from anywhere across the world. Anyone else who will like me to talk about a specific item, specific inventory item, specific experience that somebody would like to share with others? Yes, Harshad ji.
Great. This thing that see basically valuation of inventory. So from the context of Indian accounting system, so there is a AS2 or there is something. So what the impact it will make to the rather accounting valuation or valuation for the purpose of books of accounts in the light of this new IVS, and what could be the role of valuers and how you think that it has to move forward?
I don't think there is any change which is there in the standard. Like when you prepare books of account, the standard remains the same, that you have to follow, the book value method, and you have to look at the costs that you have incurred and add them to your system. But then, and you add the overheads to it, and that is the method that you have to follow. I don't see any change there. The only change and the only reaffirmation that I've got from this system is that when it talks about, allocation of overheads, there, in many cases, I have seen that what accountants and what companies do is they allocate overheads based on the cost incurred. They say, oh, we have incurred 70% of the cost on this item, and therefore let us allocate 70% of the overheads that we normally incur on a completed product. Sometimes they do that. At other times, they will say, oh, we will add 30% of our labor overhead because we have completed 30% of the work on this item. So that is accurate. But the moment they say that, no, we have already incurred 90% of the cost of this item, let us please allow us to allocate 90% of the labor to this inventory. That is something that you need to challenge, and then you need to ask them to look at the actual labor or the actual contribution of labor that has gone into the product till the time at which the inventory was processed. So that, I think, is the only thing that came to my mind when I read this, because I felt that this is a clarification which they have made in the special considerations part, which is important. Other important parts of unit of account. The unit of account is equally important. Again, you can't put all the inventory into one bracket. You might have different buckets that you want to put that in and prepare the unit of account accordingly. And of course, that is also very, very important. Most important in Indian accounting system is to value the inventory as per the physical verification and not only on the book value method. Our greatest asset in all our balance sheets is inventory sometimes, and we need to be careful about it. And I think not only us, I think everyone in the industry also needs to start looking at the inventory and start questioning it. I keep coming across balance sheets where the company has gone into insolvency, and just before it went into insolvency, it had what inventory equivalent to the next year's the previous year's complete year sale. So, what kind of business are you doing in case you have inventory which is equivalent to the full year sales? So that is what something that I think one needs to look at. We're recently doing a transaction audit where we came across some books of accounts where the fellow had cleverly sold off all the stock in his books of accounts. But then we came across some documents where he had not sold it. So I don't know where he will bring in crores of inventory now for the RP to take over. Let's see.
But inventory is a perennial valuation item. Means the value has to be ready on all days in a year. So every time you cannot engage a valuer to value the value.
That is not the purpose here. The idea is that yes, whenever the valuation event occurs, at that point in time, if somebody feels that the inventory is a significant part, then he can always appoint a valuer in case somebody is doing that job. And if you are doing the valuation of, say, a company which is undergoing, say, a transaction where you are wanting to calculate the market value of the stock of the shares. In that process, now, in case you want to comply with, say, IVS 230, IVS 230 that says that, okay, if you're computing the market value of all assets, then you should rather also compute the market value of inventory. So in that process, in case the inventory is a very significant item and contributing significantly to the entire shareholding value, then perhaps it's a good idea to restate the inventory from cost method to market method so that, wherever it is required to be done, based on the basis of value that you want to give to.
Sir, our accounting standard AS2 says that inventory is to be valued at cost or market price, whereas IVS 230 says that it should be valued at cost or market price. That accounting standard is a local law. It prevails over IVS 230 in my view.
So there is nothing. So the idea is that when you talk about IVS 230, IVS 230 is of course the specific part on inventory. Now, if you talk about AS2 says you have to value it at cost or net realizable value, not market value, if I'm not wrong. Net realizable value is what it says, whichever is lesser.
Sorry, sir.
Yeah. So net realizable value is what it says. So that of course will prevail whenever somebody is preparing their books of accounts, because they're supposed to comply with AS2, and if they don't, then the auditor is supposed to flag it, or the company is supposed to talk about it. When it comes, that is only for accounting purposes. Yeah, but if somebody says that, okay, please value the shares of my company as on a particular date, does the accounting standard 2 apply to that valuation? I don't think it does. I don't think there's any regulation which says that should apply.
There are exclusions.
So therefore, the accounting standard will not apply to a valuation exercise. But if you are maybe, part of an RVO which has adopted IVS, 230 will apply to you. So you need to then, at that case, apply 230 the way it has been structured and the way we have talked about it, where, you need to understand, okay, till what level has work been completed. Now, if you talk about raw material, let's say, so raw material, when you have talked about raw material at cost, maybe you will have to revalue it at market value in case the raw material has gone through significant changes, or, even if it has not gone through significant changes, the duty is that under 230, you need to look at the market value and try to value it. Or cost method then again points to the market value. So the idea is to look at the market value. And in most cases, you will say, oh, I have procured it, or this company has procured it at this price. So I can maybe assume that price is the market value. And in case that price is not inflated, or that price is not changed from the procurement date to the valuation date, then you can very well take that value.
Okay, sir.
In other cases, say in WIP, in work in progress cases, in finished goods cases, what a valuer, I think, will now need to do is understand the way that the valuation has been done for the stock, for the inventory. and understand the profit margins on that inventory and make some adjustments before giving a market value wherever that adjustment is required as part of the overall basis of value for the valuation that the valuer is doing. Any other questions from anyone else? So near about time, I will request somebody from APV to take over.
Could you see
AVP it is now.
AVP, yeah.
if there is any question in chat box, you can take it. Otherwise, we will give formal vote of thanks. You just check. In 1 or 2 minutes, if anyone has any question, he can ask, and then otherwise we will have vote of thanks.
AG, I'd like to connect with you on a one-to-one basis on a specific query I have on valuation, which because not related to inventory, so I don't want to waste.
Anytime, my contact number is already on the chat box. Otherwise, I can also post it on.
I have posted on chat box, so
yeah.
So we are already connected, so I'll contact you directly.
Thank you, thank you.
So now Amit Chavanji, who is CA and our member, will give formal vote of thanks for Ankitji.
Thanks, Sandeep Agrawalji.
Yeah.
Good evening, all of you. I'm CA Amit Chavan from Hyderabad. I'm proposing vote of thanks on behalf of Association of Valuation Professionals. Honorable Chief Guest, Dr. A.S. Prasad ji, and the speaker of the session, CA Ankit Goel ji, and all the participants. It's my honor to get an opportunity to thank you all. I extend my gratitude to our Honorable Chief Guest, Dr. A.S. Prasad ji, the past president of Institute of Cost Accountants of India, to take out time from his busy schedule to grace this event. Thank you, sir, for your inspiring and encouraging words on this special day. And especially thank you for conveying the importance of networking and the knowledge sharing through the AVP platform. Sir, as a valuation professional, we sincerely hope to learn more from you, and we request you for your valuable time again in the near future. I propose a vote of thanks to our beloved speaker, Mr. Ankit Goel ji, for your in-depth knowledge of the subject, practical experience, and the way in which you have conveyed the entire standard on the evaluation. It has actually reiterated the fact that as we seek more, we would understand more about any of the subjects within valuation domain. And I hope that all the participants today would be benefited when next time they work on the inventory valuation, they'll recall all the concepts that they have learned in today's webinar. So I'm grateful to you for taking time for us today from your busy schedule. Thank you, sir, for your insights on the valuation. I also thank you all the participants of the webinar for your thirst, because of your thirst of knowledge, because of your thirst for collaboration knowledge. You are the pivotal part of this program. I also thank CA Veena Badeji and CA Sejal ji for introducing chief guest and the speaker of the day respectively, and also on the presentation on the AVP. I thank Dr. Rammohan Bhave sir, founder president of AVP, and CA Sandeep Agrawal ji, head of professional development committee of AVP, and all the organizing team members who are working with Sandeep ji from the AVP to arrange this event, this webinar, which helps all the professionals to learn more about inventory valuation. I also do take this opportunity to convey you that all the participants should subscribe for the one-time membership of AVP. As Bhave sir has specified, it comes with the one-time fees of ₹5,000. And I also appeal all of you to convey your professional colleagues to subscribe for the AVP's membership and attend such webinar and share their knowledge. On this note, I see Amit Chavan to take leave today, and I would hand over the proceedings to Mr. Sandeep Agrawal ji. Thank you, all of you. Over to you, Sandeep Agrawal ji.
Thank you, Ankit ji. It was really wonderful session, and you enlightened us on the newest topic, IVS 230, which is recent and very, very new, and you have full knowledge on the subject. Thank you very much. Hope you will continue to give us knowledge, and you please share the presentation to me, and I will share to all the participants. Thank you very much for your wonderful day and celebration. Thank you, Ankit ji.
Thank you, Sandeep ji. Thank you, Amit ji. Thank you so much for the for this session. Thank you all the participants to make this very interactive and a learning experience for me. Thank you so much.
Okay, bye.
Thank you.